Welcome to the Deep Dive. Today we're really getting into the minds of investing legends Warren Buffett and Charlie Munger using Alex W. Morris's book, Buffett and Munger Unscripted.
That's right. This book pulls together insights directly from their shareholder meetings, so it's like getting their thoughts, well, unscripted. And this deep dive is basically for you, the listener, to grab those core ideas without wading through everything yourself.
Exactly. We've kind of boiled it down to 10 key areas he kept coming back to. Think of it as a shortcut to their philosophy.
10 big themes that really define their approach.
Okay, so we'll be covering value investing and why that term itself is a bit funny to them. Then valuation, how they actually figure out what something's worth.
Capital allocation, big one. What they do with the cash. Management, who they trust to run things.
Right. And then Berkshire's unique structure, the insurance business, which is so key for them, their, let's say, direct views on accounting.
Can't forget the circle of competence. Crucial. Plus, their take on economics, the market itself. And we'll wrap up with some case studies tying it all together.
Yeah, the goal is really to unpack these big ideas, make them clear, maybe spark a few of those aha moments for you without, drowning you in details. So let's jump in with value investing.
Okay, value investing. For Buffett and Munger, it's pretty straightforward at its core. It's about buying something where the future cash you expect to get out of it is worth a lot more than what you're paying today.
Simple enough. But they find the term itself odd.
Yeah, they've always been puzzled why people separate value investing from growth investing. As Buffett said back in 2012, something like, Charlie and I think there's no other kind of investment than a value investment.
Because why would you intentionally pay more than something's worth? It doesn't make sense.
Exactly. And this connects to Buffett's criticism of, well, how finance is often taught. He said in that same meeting, you really only need two courses in investing: how to value a business and how to think about market prices.
Not all the complex, fleeting theories.
Right. He felt business schools were focusing too much on fads instead of fundamentals. And Munger chimed in, pointing out how that kind of theoretical folly creeps into accounting, too.
Like using black skulls for things it wasn't meant for.
Precisely. He mentioned using it for valuing really long-term options, arguing it can be a way to, sort of legitimize numbers without truly understanding the long-term business reality.
So they prefer a more common-sense, business-focused approach. Buffett in 2015 talked about looking out 5, 10, 15 years.
Yeah, not with a crystal ball or precise spreadsheets, but trying to get a general feel for the business's future economics. And crucially, knowing what they don't know. If it's too hard to understand, they just move on.
Which leads to how they compare opportunities, right? They're not looking for moonshots necessarily.
No, they lean towards the certainty of a decent result over just hoping for a brilliant one. It's about weighing probabilities and potential outcomes across different possibilities.
And they don't just wait for luck. They talk about making their own luck.
Through curiosity, reading, learning constantly, and learning hard lessons from mistakes. They often mention the Hochschild Cone department store or blue chip stamps. Those experiences weren't fun, but they were valuable.
Munger famously said something about getting your nose whacked hard by a mistake being a great teacher.
Absolutely. Those bad experiences really sharpen their eye for what makes a truly good business. And, Buffett always adds that enjoying what you do helps you get better results, too.
Makes sense. Okay, let's shift to valuation. Their approach seems different from the standard Wall Street playbook.
You could say that. They are deeply skeptical of detailed financial projections. Munger, talking about book value, basically said projections, on average, do more harm than good.
Why? Because of bias.
Exactly. The people making the projections often have an interest, conscious or not, in a particular outcome. Optimism bias, incentives. It clouds judgment.
They even reference that Mark Twain quote about mines and liars.
Right. A mine is a hole in the ground owned by a liar. It's that level of skepticism towards predictions. So, rule 1. They generally avoid projections.
Okay, so no projections. What about book value then? Assets minus liabilities.
Buffett clarified this in '94. He said for really good businesses, the ones earning high returns on capital without needing much capital relative to their price, book value isn't the main thing to look at.
That was different from his mentor, Ben Graham.
A bit, yeah. Graham dealt with smaller sums, often buying statistically cheap companies based on assets. Easier then. But Buffett stresses they absolutely kept Graham's core philosophy.
Which was?
3 big things. First, your attitude towards the market. Graham's Mr. Market concept: the market is there to serve you with prices, not guide you. Second, the margin of safety. Always leave room for error. Third, View stocks as pieces of a business, not just blinking quotes.
And the specific math isn't the most important part.
No, it's secondary to getting those philosophical pillars right. The how you value is less critical than the mindset.
Buffett had that great analogy about PetroChina, right? The fat test.
Yeah, exactly. He said back in 2008, when they bought PetroChina, it was like seeing someone who's obviously, say, 300 pounds overweight. You don't need a scale to know they're fat. The undervaluation should be that obvious. It should hit you between the eyes.
Which Munger pointed out saves on due diligence costs, too.
Right, because they're not trying to calculate things down to the last penny if the value isn't screamingly obvious or if it's outside their understanding.
Interestingly, Buffett said traditional due diligence wouldn't have saved them from their biggest mistakes anyway.
Because their biggest mistakes, he argues, were errors of omission. Things they did understand but failed to act on, or acted too timidly.
Munger calls that thumb-sucking.
Yep, and those missed opportunities, Buffett admits, have cost them way more than the bad deals they actually did.
It's really about focusing on the big picture and having conviction. Okay, let's talk capital allocation. What do they do with the profits?
This is huge for Berkshire. Buffett often says finding businesses that can consistently reinvest large amounts of additional capital at high rates of return is incredibly rare.
Like earning 20% on $100 million is great, but can you still earn 20% on the next billion?
Exactly. Most businesses can't. He uses See's Candies or the Buffalo News as examples. Great businesses throw off lots of cash, but limited places to reinvest that cash within the candy or newspaper business at similarly high returns.
And that's where Berkshire's structure comes in.
Precisely. Berkshire can take the excess cash from See's. Munger mentioned See's has generated something like $1 billion pre-tax for Berkshire over time, cash that See's couldn't profitably use itself, and move it to other Berkshire businesses or investments that do have good uses for it.
Munger had those two categories for businesses that aren't home runs for reinvestment, right?
Yeah, the good but not fabulous. One type generates surplus cash like See's. The other type looks profitable on paper, but somehow never has any free cash. He mentioned a used construction equipment business as an example. Berkshire can allocate capital away from both.
What about buying back their own shares? Share repurchases.
For them, it's remarkably simple logic. Buffett laid it out in 2015. If you have cash left over after taking care of the business needs, and your stock is selling for less than you think it's intrinsically worth, buy it back.
The partnership analogy.
Right. If you and I own a business together, and I offer to sell you my half for way less than it's worth, you should take the deal. It benefits the remaining owner, you.
Buying $1 for 80 cents. Buffett felt a bit bad for the seller, though.
Yeah, he admitted mixed emotions because it means someone is selling out too cheap, but it's clearly good for the continuing shareholders.
And they even raised their own limit for buybacks from 1.1 times book value to 1.2.
Correct, because they felt the gap between book value and intrinsic value was widening. But they're also cautious about having too much cash lying around, as it can tempt companies into doing dumb things.
They contrast their approach with others who buy back stock at high prices.
Definitely. They criticize companies, often spurred on by advisors, that buy back stock aggressively when it's expensive, without clear logic, maybe just to prop up the price or earnings per share temporarily.
Their first preference, though, is always buying whole businesses.
Absolutely. If they can buy a great business entirely, that's usually plan A. But, as Buffett noted just last year, in public markets, it's tough. Sellers have the option to shop around for higher bids.
But Berkshire's structure lets them move fast when needed.
Yes, unique situations where speed and certainty matter. Think Harley-Davidson during the 2008 crisis, or buying that Dynegy pipeline in 2002. Buffett even talked about calling the FTC directly to speed things up. That ability to deploy huge sums quickly is a real edge.
Okay, shifting gears to management. What do they look for in leaders?
Top priority for Buffett. He said this back in '98. Find managers who truly love the business more than they just love the money.
And Berkshire tries not to mess that up.
Exactly. They want to avoid doing things that kill that passion. That's why so many Berkshire managers keep working long after they need the paycheck.
Yeah.
They genuinely love what they do.
Munger's criteria were pretty simple.
Very. Integrity, intelligence, experience, and dedication. Get those right, and you're most of the way there.
Now, executive stock options.
Oh, yeah.
They have strong views there.
Oh, yes. Munger told a story once about a banker who literally thought issuing shares for options cost nothing. It showed a fundamental misunderstanding, and Buffett hates it when managers seem happy the stock price is down because they can issue themselves cheaper options.
What's Berkshire's approach to compensation then? It sounds different.
Very. Buffett talks about charging managers a sort of 15% pre-tax cost of capital on the assets they manage. It makes them think like owners about the capital they're using.
So they hate compensation that ignores capital costs.
Absolutely. They blast fixed-price stock options that don't account for the capital shareholders provide, their view. Options, if used at all, should be priced at or above intrinsic value and carry a cost for using shareholder capital.
They have that extreme system too.
Right, where executives can just buy Berkshire stock in the market with their own cash. Munger finds it amazing how few executives elsewhere do that.
The goal is aligning thinking.
Always. How do you get managers to think like owners? Well, make them owners. Buffett did concede in '96 that for top execs allocating Berkshire's overall capital, maybe a carefully designed option plan with a cost of capital built in could make sense.
But he hates the hypocrisy he sees elsewhere.
Yeah, CEOs calling their stock ridiculously low when discussing selling the company, then turning around and granting themselves options at that same low price.
Yeah.
That drives him crazy. They both think corporate pay in America is often horribly wrong because of that options cost nothing fallacy, leading to huge excesses.
And what about handling bad news?
Bring it on and bring it early. Buffett said in '95 he's more interested in bad news than good. The instruction to managers is, think like an owner and tell us bad news immediately. We can handle bad news. We can't handle surprises.
It relies on trust and principles, given how decentralized Berkshire is.
Hugely. It relies on behavior, reputation. They often quote that Salomon Brothers line about losing reputation being catastrophic. And the Wells Fargo cross-selling mess is their go-to example of how bad incentive systems can destroy value and trust.
It really all comes back to alignment and integrity. Let's talk about Berkshire's structure itself. Why is it so hard to copy?
Buffett thinks it's a huge competitive advantage, partly because the culture is so ingrained and unique. He said this back in 2009. It's very hard for others to replicate.
Plus that unusual shareholder base.
Yeah, incredibly low turnover compared to most big companies. They attract long-term owners, including families selling their private businesses who want a permanent home and often want to keep running their company without public market pressures.
And they believe the culture will outlast them.
They do. It's deeply embedded. Munger even joked that the stupidity of management practice elsewhere actually helps Berkshire by comparison.
The culture gets reinforced by the shareholders themselves, who are seen as partners.
Absolutely. And the board is very owner-oriented, business-savvy. It's not a typical corporate board.
And the decentralization is key. No head office demanding quarterly bumps.
Right. Buffett also stressed in '96 that Berkshire's value isn't just the sum of its parts you'd get in a breakup. It's a dynamic thing, with synergies, especially from things like the insurance operations feeding capital to other parts.
The growth of that insurance business since the early 70s is incredible.
It's a prime example of value creation within the structure. And that structure, with its capital and speed, lets them do things like Mid-American's huge renewable investments or swoop in on Constellation Energy in 2017.
Even their utilities benefit from the structure.
Yeah, Buffett argues they can operate more efficiently and invest more rationally for the long term because they were part of Berkshire compared to typical regulated utilities.
It's a powerful self-reinforcing system. Okay, let's dive into insurance specifically. It's so central.
It really is. Buffett explained back in '95 there are two basic reasons to buy insurance. One, protection against a loss you truly can't afford or bear. Two, you think you have a mathematical edge because it's underpriced.
And Berkshire sells mostly the first type.
Primarily, yes. Especially reinsurance insuring other insurers against huge losses. Think California earthquake policies, massive potential losses concentrated in one event.
And then there's the float.
Ah, the magic float.
Yeah.
The premiums collected up front that insurers hold before paying claims. At Berkshire, this float has been long-term, growing, and historically cost-free or better. Buffett called it massively valuable in 2019.
Their property casualty operation is seen as world-class.
Definitely. Buffett points out an irony, though. To be truly safe for the absolute worst-case disasters, an insurer needs so much capital it might not be a great business day-to-day. And reinsurance, the backup for insurers, can fail exactly when everyone needs it most in a mega catastrophe.
But Berkshire is different.
Because of its massive, diversified asset base outside of insurance and its ability to pay claims without relying heavily on potentially shaky reinsurance, it's uniquely positioned. He noted how the top global reinsurers have faced near-death experiences, while Berkshire remains solid.
What about the Gen Re acquisition? That had lessons.
It did. Buffett said January was off track when they bought it, too focused on just growing premium volume instead of underwriting profit. They had to refocus on profitability, even if it meant shrinking, and get rid of accommodation business writing underpriced policies just to keep clients happy.
Insurance sounds like a business with financial pitfalls.
Oh, definitely. Unpleasant surprises can pop up years later, and incentives in underwriting, if not designed carefully, can lead to really bad decisions. Discipline is paramount.
Discipline seems key everywhere for them. Let's hit accounting. They don't mince words here.
Not at all. They despise ignoring depreciation as a real cost. Buffett in 2003 called it absolutely crazy, like reverse float. It's a real expense needed just to stay even.
And they blame investment bankers for popularizing metrics like EBITDA.
Partly, yes. Metrics that obscure real costs. Munger's take on EBITDA is famously blunt. Bullshit earnings.
Because you have to spend that depreciation amount, usually more, just to maintain the business.
Correct. To stand still economically, you typically need to spend at least your depreciation charge. Ignoring it is fantasy.
What about earnings management? Smoothing things out quarter to quarter?
Buffett said in 2005 he doesn't focus on quarterly numbers. He knows there's flexibility, especially in things like insurance loss reserves. But he warns strongly against systems that make managers worry about hitting quarterly targets. That inevitably leads to bad long-term decisions.
So transparency and economic reality over short-term appearances, okay? The circle of competence. This feels central.
Hugely central. The 5-minute test they talk about? That's decades of experience allowing them to quickly filter businesses. Buffett said in '97 they basically know something about almost every big U.S. company like a baseball scout knows players.
So they can quickly decide if something's in their circle and worth a deeper look.
Right. Using mental filters honed over time, they bought flight safety, for instance, after knowing the business casually for 20 years without needing exhaustive new due diligence. Their filters focus on fundamental economics, not stuff you learn from typical reports.
Munger emphasizes sticking to a few big, simple ideas.
Yes. Keep it simple. Stay where you have an edge, which is why they historically avoided tech, right?
Munger's quote from '99.
It's not an easy investment decision for us, and that's what we're looking for. If it's not easy for them, meaning within their circle, they pass. Even if it looks like a potential jackpot.
They don't feel they have to play every game.
Not at all. Buffett uses Bill Gates as an example. Gates invests within his circle, tech, applying similar principles. They accept their circle isn't likely to get much bigger now, and they're happy to wait for pitches in their zone.
Past failures reinforce this.
Definitely. Trying to figure out complex businesses they didn't truly understand taught them to stick to what they know. The key test. Can you confidently predict or at least understand the key variables for the business in 10 years? For many tech companies, they felt the answer was no.
And they contrast different business types within that circle.
Yeah, high capital businesses like utilities versus low capital, high return businesses. The latter is the ideal, of course. They own great businesses, just maybe not the scale of the giant tech firms.
It's about knowing your limits and being patient. Finally, let's talk economics and their view of the market.
Mr. Market is the star here, Ben Graham's concept, which Buffett loves explaining. Think of the market as this manic depressive partner, Mr. Market, offer you crazy high or low prices every day.
The key is
use him. Don't be guided by him. His moods offer opportunities to buy when he's depressed, maybe sell when he's euphoric, but never take his quotes as a measure of true value. Stock mispricing is built into the system. It's your opportunity.
So base your decisions on your own valuation, ignore the noise.
Exactly. Own stocks like you'd own a farm, Buffett says. Focus on the farm's output, not daily quotes on its value. And be ready for big price swings. He reminds people Berkshire itself has dropped 50% multiple times. You need psychological stability.
They don't seem to have much financial fear.
None, really.
Wow.
Buffett actually thinks amateur investors who know their limits can beat pros in aggregate, mainly due to lower costs and less churn. He'd happily bet a low-cost index fund against most active managers over 10 years.
What about inflation?
Low inflation is generally good for owners, Buffett said in '03. It allows real returns to be higher over time. GDP growth translates more effectively into real profit growth.
How do you protect purchasing power against inflation then?
Best way, according to Buffett in '04, is your own earning power. Second best is owning wonderful businesses that need little capital and have pricing power. Seize candies again. Inflation is the enemy of the investor trying to grow real wealth.
Having not a lot of silly needs helps too, as Munger would say.
Right. And the difficulty a business has raising prices. That's a sign of a tough business, especially in inflation. The ideal asset. a royalty on someone else's growing sales.
Global diversification isn't a primary driver for them.
Not really. It's understand the business like the management, attractive price. Where it is matters less than those factors. They also admit they rarely time market bottoms perfectly. They focus on getting value and hope the price goes down after they start buying so they can buy more, cheaper.
They see investing as simple, but the industry complicates it.
Very much so. The basics are simple, but there's a huge industry with an incentive to make it seem complex and charge fees for navigating that complexity.
And all these ideas are illustrated throughout the book with examples, right? We've touched on many.
Absolutely. Geico's unusual growth, sees enduring advantages and reinvestment limits, PetroChina's obvious undervaluation, turning Jinri around by focusing on profit, the Wells Fargo incentive disaster.
Berkshire's whole insurance model, the quick Dynegy deal, contrasting businesses like Coca-Cola versus airlines, they all bring these principles to life.
They're not just abstract theories. These are the ideas applied in the real world through decades of experience.
So wrapping this deep dive up, what are the big, lasting takeaways from Buffett and Munger Unscripted?
I think the biggest thing is how interconnected it all is. The long-term perspective is vital because it lets value investing work. Understanding businesses deeply is crucial for smart capital allocation and judging management.
The focus on value, the margin of safety, they're the foundation.
Exactly. And staying in your circle of competence isn't about being timid. It's about avoiding big mistakes. And underpinning it all is temperament, rationality, patience, discipline, especially when markets get crazy.
Plus that constant emphasis on learning from mistakes, yours and others, and the power of just sticking to a few simple, big ideas over time.
Absolutely. So maybe the final thought for you, our listener, is this. How can you start applying these fundamental principles, maybe just one or two to start, to how you think about business or investing or even just making decisions? Which of these ideas really hit home for you today?
Reflect on those aha moments. And if you want more, definitely check out the book itself or dive into the Berkshire Hathaway annual letters. They're a masterclass in themselves. Thanks for joining us on this deep dive.